What's up, everybody? Welcome back to the stocktrades.ca YouTube channel. My name is Dan. I'm one of the co-owners over at stocktrades.ca, and if you're new to the channel, we primarily focus on individual stocks on this channel with a Canadian focus. However, this week we've got something really cool. We're going to go over our top 10 blue chip stocks here in Canada, and the best part about this is the vast majority of these stocks are dual traded, which means if you are an American investor, an investor looking for US stocks that have a Canadian focus, this video will definitely be for you. So with that being said, let's get started. So we've got 10 stocks in this video, and the one thing I need you to do is, first off, watch the video, and second of all, after you're done watching the video, comment down below and let us know if you'd like to see more stocks like this but go less in detail on each stock, or if you really want us to stick to the usual, 2 or 3 stocks in depth. So why do we have 10 stocks? Well, this is actually a list that we compiled over at stocktrades.ca. We have a ton of top stock lists over at stocktrades.ca, and we typically update these semi-annually. So our blue chip article is fresh. It contains a ton of new stocks, a ton of new research, but we definitely want to hear from you. So if at any point in this video you have a blue chip stock you've thought of that we haven't listed on here, or you own 1, 2, 3, 4, I own a bunch of the stocks on this list, then just drop a comment below. Most importantly, if you're new to the channel or you've been lurking the channel for a very long time, and I know there is a lot of people out there who watch our videos but don't subscribe, smash that subscribe button, and most importantly, hit that like button. It helps us with the YouTube search algorithm, helps us get more traffic, and it lets us continue to be able to create great videos. So with that being said, let's get down to our first blue chip stock to look at moving forward in 2020 and into 2021, and that is Barrick Gold. So regardless if you're a Stock Trades Premium member or just a regular reader, although we have preached it to premium members a lot more over the past while, we believe that you need exposure to gold at all times. So why did we choose Barrick Gold as our blue chip Canadian gold stock to own? Well, first off, they are the biggest gold stock in the country with a market cap of just over $66 billion at the time of filming. They have a 1-year dividend growth rate of 41%. So the company has been able to grow its dividend at a pretty rapid clip due to the increasing price of gold. And they have a payout ratio in terms of earnings of only 40.67%. So that shows that this company is going to be able to grow its dividend further. And with a 3-year dividend growth streak, I would be very, very surprised if Barrick Gold did not hit dividend aristocrat status, Canadian aristocrat status of 5 years or more. The yield is small. It's around 1.16%. You can find higher gold yielders, but most importantly, we're not strictly focused on yield. We just believe Barrick Gold to be the most stable gold stock moving forward, and thus a blue chip. So the problem with gold companies during the last bull market, they were very irresponsible, and they often made acquisitions and purchases at extremely high prices. So this left them with extremely high debt loads. Once the price of gold crashed, most of them are very poorly prepared, and it resulted in a ton of dividend cuts, defaults, write-downs, things like that. So if we fast forward to today, you can say that most gold producers thus far look like they've learned their lesson. They're leaner, they're taking a much more disciplined approach to capital investments, and that's pretty much what we want to look for. We want to look for a gold company who's going to perform in both a bull market and a bear market, because we want gold exposure at all times. We're not looking to flip in and out. So Barrick, one of the biggest gold stocks in the world, and it has emerged from the bear market stronger than ever, really. So in terms of ticker, if you're looking for this stock in Canada, its ticker is ABX, and it has a much cooler ticker name down on the New York Stock Exchange. It is GOLD, G-O-L-D. So now that we've gone over our blue chip gold play, which is benefiting immensely from a higher price of gold, let's move on to another sector, which is actually being pushed down due to a lower price of oil, and that is pipelines. And the stock we're going to talk about, the blue chip Canadian stock, is TC Energy. So obviously we know the oil and gas industry has been absolutely decimated due to COVID-19. However, there is a particular sector in the whole energy industry that is actually performing quite well, and that is midstream dividend paying companies. So pipeline companies. So there's a few options we could have went with here. We could have went with Enbridge, but we decided to go with TC Energy just because they've performed a lot better than Enbridge over the last while, and we also view their dividend as safer. So pipelines, a lot of people don't know the industry that well, and they think they're as susceptible to the price of oil as a producer, but that's simply not the case. Most of the time this is because these pipelines operate with take or pay contracts, which are essentially contracts, long-term contracts that they sign with the oil producers that results in them getting paid regardless of the product being shipped. So as a result, cash flows are much more consistent. They're allowed to increase their dividend at a more rapid clip than, say, a producer. And also when the price of oil tanks like this, because they're still getting paid to ship product. So thus far in 2020, we've seen oil producers like Suncor, Canadian Natural, Imperial Oil down, in the case of Suncor, significantly. I think even Canadian Natural is still down 40+% year to date. But TC Energy has only lost 13% of its value and has held up much better than its peers. The company stated last quarter that despite the challenges brought about by COVID-19, our assets have been largely unimpacted. It went on to say that its 2020 outlook remained unchanged as 95% of EBITDA is underpinned by regulated assets and or long-term contracts. The company has critical infrastructure across North America, and it expects to spend $37 billion on growth projects through 2023. The majority of this will be spent on natural gas pipelines, which is critical. Natural gas is not going anywhere. So to go along with this, the company also reiterated dividend growth guidance through 2021. So this is a company in the oil and gas sector. Instead of desperately trying to keep its dividend maintained, they actually said they're going to raise dividends. So a huge benefit. So if you're looking for a pipeline company, an oil and gas company, we would highly suggest avoiding producers. Last year, there's a very good chance that a company like Suncor would have been on this blue chip list, but a lot of things have changed. Instead, TC Energy, 5.5% yield, dividend is well covered. They're probably going to continue growing the dividend, and they've also got a ton of projects in the pipeline that will allow them to continue to grow in the future. So ticker wise, they trade under the ticker TRP on both the New York Stock Exchange and the Toronto Stock Exchange. So moving on to our next stock, we're going to talk about one of Canada's biggest railways, and that is Canadian Pacific Railroad. So if somebody gave you the option to look at a single stock and you needed to tell them from looking at that stock where the Canadian economy was heading, what would you choose? Well, for me, I would choose railways, whether it be CP Rail or CNR. We're going to speak on both of them. First one here, CP Rail. They are the bellwether for the Canadian economy. If railways are doing well, if railways predict they aren't going to do well, that is a huge sign of where the country is headed economically. Prior to 2012, CP Rail was actually having some pretty significant operating issues, led to a lot of tough decisions, but over the last while, it has actually outperformed its much larger peer, CN Rail. It has transformed itself from the lowest margin railroad to the highest of all publicly listed North American railroads. So operational issues are in the rearview mirror. They've returned to dividend growth. And in July of this year, the company extended its dividend growth streak to 5 years, and it raised its dividend by 15%. So the company actually expects high single-digit earnings over the next year, which is actually pretty impressive for a railway company. And they've only missed in terms of earnings estimates once over the last 3 years. So 12 quarters, they've hit 11 out of 12 analyst estimates. And obviously with a blue chip stock, you want defensive options. And CN Rail is actually up 20% this year, outperforming the TSX index by a wide margin. So CP Rail trades under the ticker CP on both the TSX and the New York Stock Exchange. So moving forward, our next pick is actually going to be a tech stock, which is crazy to think about because if we were to have made this list even last year, we probably wouldn't have included a tech option. Tech stocks were pretty much reserved for investors with a higher appetite for risk, and not a lot of Canadians looking for blue chip options would have chosen one. But moving forward in 2020, we actually think that not having exposure to tech is a huge issue. And as a result, Constellation Software is our blue chip tech stock. So south of the border in the United States, tech makes up almost 25% of the markets. It's only 9% here. So a couple of years ago, this was actually sat at 6%. So the Canadian markets in terms of tech stocks are growing. And this is why we're including a tech option on this list. So Constellation Software is one of the best managed companies on the TSX index. Over the last decade, its stock prices increased by 1,300%, and it has one of the best track records in the industry. It does pay a dividend. It's a very minuscule dividend. Its yield is 0.3%. And its payout ratio is around 12%. You're not exactly looking at this company for its dividend. You're looking at it for overall returns. $10,000 in the company 10 years ago would be worth over $351,000 today. This is without demanding some of the crazy valuations you see with stocks like Shopify and Kinaxis. That's a compound annual growth rate of 47% over the last decade. They're the best consolidator in the industry. It acquires companies and seamlessly brings them into the fold. It does this on a consistent basis. Now, the one issue with Constellation is it doesn't provide quarterly conference calls. You have to rely strictly on the management of this company as it only produces annual reports. So moving on to our next stock, and this one is really going to surprise you. It is Canadian Apartments REIT. A lot of people are asking us, how can you include a REIT on a blue chip stock list today, especially considering this pandemic? And although the sector as a whole is under pressure, there are certain industries that are more stable than others. And one of those industries that is more stable is multi-unit residential properties. Canadian Apartment Properties provides excellent value. It is also in very strong financial shape. It has a debt to gross book value of only 36%, and considering that a rate below 50 is considered strong when looking at a real estate trust, this is crucial, and it's also one of the lowest in the industry. The company's 2.98% dividend yield is very well covered, accounting for only 73% of adjusted funds from operations. When you consider a company like RioCan, for example, is in the mid to high 90% range right now due to COVID, this is a very safe payout ratio. Again, it's one of the top tier listed REITs in terms of payout ratios. The company is currently trading at a 17% discount to its cash flows and a 14% discount to its net asset value. So overall, Canadian Apartments REIT does have the highest risk on this list. There is no doubt about it, but it also to us has the best risk reward blend in terms of overall returns. And if you're looking for exposure to real estate, it may be wise right now to stick to residential options. So one thing about Canadian Apartments REIT is it doesn't trade down south. If you want this one, you're going to have to buy the Canadian ticker, which is CAR.UN. So little break from the video. We've gone over the first 5 and we're going to go over the next 5. But I wanted to pause to remind you that if you like the video, if you like what you saw thus far, smash that like button, hit that subscribe button to get more updates from us, more videos. We usually post weekly content, and we also provide updates for new articles over at stocktrades.ca, which is one of Canada's biggest investing websites. But that being said, let's get back to the video and our next blue chip stock, which is BCE. BCE is one of the largest telecom companies in the country. It's grouped together with the big 3, which are TELUS, Rogers, and Bell. I am an owner of TELUS. I don't own BCE, and I also don't like Rogers. Not a big fan. When I buy telecoms, I'm buying them for income and dividend growth. and Rogers decided not to raise the dividend. So that was pretty much a canceling factor for me. But in terms of blue chip stocks, you really can't go wrong with any of the three. What sets BCE apart really is its ability to generate new subscribers in a mature market and just the sheer size of it. It has a market cap of over $50 billion. If we compare this to a company like TELUS, they have a market cap of around $28 billion. So it is much bigger. The company's strength is in its product innovation and providing the fastest network possible to Canadians. So this is why they have a customer base that now exceeds 9 million subscribers. So in terms of blue chips, you definitely want companies that have wide economic moats. It's hard for other companies to come in and steal market share. And to be honest, besides maybe pipelines with Enbridge and TC Energy, there is not a bigger regulated monopoly in the country. Pretty much an impenetrable business. I mean, we've seen Shaw try to take a stab at it, and they still are, but it's not going as expected. It is just really hard to take any sort of revenue share away from these companies. So the company is also one of the best income stocks in the country. They have a dividend yield that's approaching 6% and an 11-year dividend growth streak. There has been better telecom plays in terms of growth, but in terms of blue chip options, BCE is an excellent choice. In terms of tickers, BCE trades under both the ticker BCE here on the TSX and on the New York Stock Exchange. So there's been one particular sector in 2020 that has outperformed drastically, and that is the consumer staple sector. More than likely because of the pandemic, grocery stores have remained open. Dollar stores like Dollarama have provided stable revenues throughout the pandemic, just because of the fact they were able to stay open and people still need these necessities. So as a result, we could not make this blue chip stock list without having at least one grocer on the list, and we decided to include Metro. So obviously we still need our basic necessities always, regardless of the pandemic. So that's primarily why year-to-date Metro's stock price is up by 19.46%. Metro is a pillar of consistency. There's nothing flashy. There's just consistent and reliable growth in terms of both share price and its dividend. So the company does have a low yield. They're in the 1.4 to 1.5% range. But they have raised dividends for over 2.5 decades. And this is actually the 7th longest streak in the country. This is up there with pipeline companies like Enbridge. And they're also one of only 10 Canadian companies that have managed to grow dividends by double digits over the past 1, 3, 5, and 10-year timelines. So we are officially in a second wave in terms of COVID-19. So there is a very strong possibility that people are going to be rushing out again and purchasing necessary goods. And people want to shop in bulk in light of secondary shutdowns. They want to have the goods in their home so they don't have to leave their home. And this will ultimately benefit Metro. So in terms of tickers, Metro trades under MRU here on the TSX. They actually don't trade south of the border. So our next blue chip stock, and one that is simply a no-brainer, it's another railroad, and that is CN Rail. So as we mentioned before with Canadian Pacific, they form essentially a dual monopoly. The company has over 33,000 kilometers worth of track and essentially ships critical goods across the country. In terms of dividend growth, the company has raised dividends for 24 straight years. This is fairly impressive. It's one of the longer streaks in the country, as we've seen with Metro at the 25-year dividend growth streak. But they've also managed to raise dividends at a 16.5% pace annually over the last 5 years. Now, CN Rail does yield in the mid 1% range, and a lot of people are wondering, well, how can they grow their dividend that fast and have such a low yield? That's because their stock price is consistently going upwards. In fact, over the last 5 years, they have almost outperformed the index at a rate of 5 times, returning 100.8%, with the TSX returning 22.3%. Simply put, considering this company has a market cap in excess of $100 billion, one of the largest companies in the country, to get a 20.34% annual return is pretty solid. And the company has also outperformed CP Rail by around 500 basis points. CN Rail trades under the ticker CNR here in Canada and CNI on the New York Stock Exchange. So moving on to our next blue chip stock, and it's actually, surprisingly, the first financial stock on this list, and that is what we feel is the best bank in the country right now, Royal Bank of Canada. Royal Bank is Canada's second largest company by market cap. The only company larger is Shopify right now, essentially due to rapid growth. Now, the one important thing and an interesting note to look at here is in 2019, the Royal Bank of Canada paid out more in dividends than Shopify had in total revenue. So this just shows you that although Shopify is larger on a market cap basis, Royal Bank is a massive company. They have a market cap of around $135 billion right now, and they have operations in both Canada, the United States, and what sets them aside from all other major banks here in Canada is the fact that they have exposure to 40 other countries. Bank of Nova Scotia used to be Canada's international bank, but the Royal Bank of Canada has since surpassed it as the Bank of Nova Scotia has really struggled to integrate and synergize its international expansion. So in terms of dividend, they are actually the lowest yielding out of the 5 major banks at 4.61%. But one of the main reasons for this is the fact that their share price is actually recovering drastically more than a company like, say, Bank of Nova Scotia, Bank of Montreal, or Toronto Dominion Bank. And this is because they have that global exposure and they're exposed to a lot of countries who are recovering and at different stages of recovery from COVID-19. Whereas a company like TD Bank, who has the bulk of its revenue in North America, is currently dealing with essentially a ton of its revenues coming in the epicenter of the virus right now, the United States. In terms of ticker, you can find this trading under RY on the TSX and also RY on the New York Stock Exchange as well. So last but not least, our final blue chip stock. And to be honest, if you see a blue chip stock list here in Canada that doesn't contain this stock, you should probably look for another list, and that is Fortis. So Fortis is one of the top 15 utility companies in North America, and the company generates 99% of its revenue from regulated utilities. So what exactly is a regulated utility? Well, this means that the company essentially owns the meter box, the poles, the wires leading back to the generation methods. There is no way for competition to enter and take market share from Fortis. So in the town you live in or the municipality you live in, it's very likely that a company like Fortis will go to the municipality. They'll discuss a comfortable energy rate that both guarantees profit for Fortis and is a low cost for the consumer. They'll agree upon that price and serve you electricity, which everybody needs. It's one of the last things we'll shut off. As a result of this essentially regulated monopoly, Fortis is able to have very consistent cash flows. As a result, it's raised its dividend for 46 straight years, and I would be very surprised if this company did not become a dividend king, which is 50 straight years of dividend growth. So much like telecoms, like BCE we spoke about, Fortis should be able to take advantage of low interest rates. Utilities is a very capital intensive business. They have to take on a lot of debt, and as a result, high interest rates are not good for these companies. But in the environment we're in, it's pretty reasonable to expect that interest rates are not going anywhere for some time now. And as a result, Fortis should bode well. So that's pretty much it for the video. Long video, but we went over a ton of stocks, and I really hope you gained a lot of information from this. Like I said, drop a comment down below if you like these types of videos where we go over more stocks in a more condensed amount of time instead of really opening the books up on a few stocks. We'll continue to produce videos just like these. But if you want to see more detail on fewer stocks, then we'll continue to make videos like those. But I'm going to put an end to it right now because it's running quite long. Smash that like button. It really helps us with the YouTube search algorithm, brings more Canadians, more Americans to our videos. It's the only reason we can continue to bring content to you is if more people watch it. And hit that subscribe button so you don't miss out on more great Canadian stocks. Till next time.